Who the heck wants to make markets in a product that is undeliverable?
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. You know, Live from the Vault is a show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. You know, we bring you exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets as we expose what's really going on in the precious metals industry. So get ready for another packed episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media just will not provide. So just before we head over to the UK, please help keep spreading the word about this channel by hitting that like button. It really helps the channel get out to more people. Share this information and also subscribe if you haven't already done so. And again, you can really help the channel grow even more. And so if you click on that bell right there, the black one, will notify you as each episode goes live. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire. Hey, Andrew, as you summed up during our last episode, you know, we recorded, it seems like a lot longer, but on November 27th, you know, based on the real supply and demand fundamentals, you were absolutely sure that November 14th, that bottom in gold there that you had called had anchored the next sequential physically driven gold stair step. Now, we had a lot of positive feedback after you drew attention to that blue circle you had drawn on the charts illustrating where the next Chinese-driven physical gold rally had begun. Now, I know you've got a lot to address here of important questions that we've received, but can we start off this week by picking up on the shorter-term thread that you're seeing here?
Yeah, hey, great to be with you, Shane. Thanks for all the questions, guys. Let's get into it. There's so much to unpack here. But as you say, Shane, let's start by taking a really quick look at the short-term action. And then we're going to address some of these main subscriber questions that relate to Trump's BRICS tariff threat, the CME's announcement. They're launching a tiny 1 ounce gold futures contract on the 13th of January. And we're going to take a very quick look at these charts. But there's a lot in the bigger picture. There's a lot to look at in the bigger picture. A lot of stuff to go over, especially related to silver. You'll be pleased with that there, Shane. And what we're looking to do is to continue to cut through this deliberately introduced paper market uncertainty, which is deliberately put in. And then so that we can hunt out opportunities just as the crowd gets wrong-footed. Now, I'm going to look at the charts now, but just bearing in mind that we're recording this between the AM and the PM fix on Wednesday, the 11th.
Now, we stripped down these charts so that they're simplified and easier to read. So what we're evidencing is that despite the Fed's best efforts to cap the rising dollar price for gold by trying to inflict another failed technical damage attempt into rate cut uncertainty ahead of and after non-farm payrolls, and we saw that here, this attempt. And in fact, this is where we were recording the last episode on the 27th. So right at this level here, and I'll draw attention to this BIS short covering in a second. But essentially, the action in gold and silver futures ending up netting out bullishly constructive. Now, it looked like, and many people were saying, we're going to look for a big correction at this point. If you remember, we'd seen a retracement, but we'd also seen a little bit of a rally. But a lot of people were saying this was the top and that we were now looking for 2,500. It just didn't make any sense, and that's why we drew a blue circle here last time. Now, It was constructive because the Fed-induced synthetic gold and silver bid-pulling efforts once again ended up hitting the identified rising central bank sovereign and institutional bids, forcing discipline on the insiders exposed to delivering these physical delivery obligations. And we've seen that consistently as gold has risen and pulled back. And just a quick note while we're talking about the Bank of International Settlements. Following the Fed topping up the Bank of International Settlements gold loans to 157 tons in August, and this was around about 2,400 when they started adding these. They were short covering, but it had still reached an excess of 157 tons. So then they were forced to short cover these loans sequentially at around up to $300 higher, further evidencing the Fed is on the back foot. Now, we've just confirmed, once again, the latest BIS November gold swaps report shows the Fed had repaid another 12 tons of gold, cutting these loans to 76 tons. Look, the Fed is the only global central bank that is naked short gold, and having lost pricing power against the increasingly liquid, physically settled prices, they no longer can control, that is, liquidity providers assess they'll have to square up the remaining increasingly underwater 75 tons of bets against gold by the end of the year. In other words, these deliberately constructed Fed selling efforts rely on the useful full momentum traders who control 75% of all the open interest, which we call casino chips because they're backed by nothing, and it relies on them taking the bait. But once again, despite throwing the kitchen sink here and sucking them in short, and usually they get about $100 up and down before they realize they're wrong-footed, and despite these efforts, they fail to generate enough leverage momentum-driven sell ignition to inflict any technical damage at all. Now, what they usually try and do is try and find people who've gone long, and certainly there'd have been longs here, and if they could have created enough sell ignition to trap them, we would have indeed breached the 2,500 level. Well, that's assuming there was no central buyers there, but we know there were, and they were front run, as pointed out last time. Now, all of this suggests both gold and silver are coiling for a strong end-of-year rally. Now, each successive failed Fed attempt to cap gold exposes the Fed's weakening gold hand being read by the global South central banks and sovereigns who take full advantage of the Fed's efforts to sell freshly printed fiat gold, not real gold, fiat gold, in their efforts to try and slow down the buy-stealth, unstoppable global central bank price revaluation that we can see underway. And as we drew attention to last time, when we were recording this episode on the 27th here, much as the strategically timed launch of the Shanghai Futures Exchange, how that blindsided traders betting against gold, the stealthy Chinese BRICS-related initiative to allow over 55 million SMEs to access and trade fully paid for physical gold and silver on the SGE physical exchange is going to ultimately attract hundreds of tons of Western-sourced gold and silver into China to meet this demand. We also drew attention in our last episode, these fresh PBOC bullish gold and silver drivers once more became evident. This is why we identified this blue circled higher stair step being anchored in both gold and silver on the 14th of November. Both of these gold revaluation events provided headwinds against the wrong at both ends momentum sellers who, obviously in the middle they're right, but they're wrong at both ends. And of course the insiders, the cartel, knows exactly those points. So then obviously they're blind to the bullion banks buying gold into them, which is exactly what's happening because they still continue to try and cap rises in gold and silver. And we see it consistently. And again, we're going to run into, I'm recording this between the AM and the PM fix, and it's before news. I think we've got CPI today. So obviously that is going to be volatile, but I mean, they'll use every effort to try and sell rallies. They're not long yet, which is actually great news because very short term, we've evidenced gold open interest migrating into Bitcoin futures. And while we wish good riddance to these volatility driving momentums, switching then 75% of the gold and silver open interest they control into Bitcoin futures, we are actually evidencing institutional safe haven Bitcoin purchasers hedging some of this risk into gold. Why? It's a first-tier asset class. However, what has still not been realized is that the surprise opening of the over 55 million SMEs to access silver will be the catalyst to revalue silver. So large is the silver paper to physical divide, which so far was able to be maintained because unallocated paper silver flows were managed by the so-called LBMA professional trade, who had a monopoly on silver, being able to silo these flows, shuffling these cash settlements among the cartel books for years, in fact, ever since the COMEX was launched. But this diluted paper market liquidity has migrated to physical exchanges. And other than what flows in and out of the unallocated silver ETFs, which are still unallocated, these physical flows now bypass London altogether. But as we looked at last time, while gold was in the PBO's revaluation crosshairs when they opened up the Shanghai Futures Exchange for gold, and also silver on the 1st of March, China's industrial and military base is reported to be absolutely starved of silver supply to meet its requirements. And don't forget, there are war efforts underway. And although lagging gold, real supply-demand physical prices are increasingly being discovered by silver liquidity bypassing London and flowing directly into the SGE, where unlike the Western exchanges, including the unallocated silver foreign exchange markets, physical bars have to be owned for them to be traded. Now, this new PBOC incentive will drive a race by Western market fiat silver sellers to short cover foreign exchange silver into a bid-only short squeeze setup, not seen since the $18 rally 2020 COVID short squeeze. And while that was, again, a physical shortage, it's completely different to what's driving this one here. It's not just a physical shortage. There is no market shut down. This is a supply-demand price being established in the physical markets. There is a seller and there is a buyer at every single price. Only it's going to be significantly higher. And certainly there's enough of a short momentum to blow silver through every known resistance, including its $50 May 1st, 2011 highs. This is as bullish a setup. Again, this is the low. We marked the low here and the current high, although obviously that doesn't count for the previous highs. But essentially, this low here was a major driver. And yes, there was, again, that this was before, this was exactly where gold was revalued as a first-tier asset class. And obviously that has an influence with silver. So we're now seeing what is really essentially a hugely bullish setup in silver and an extremely bullish setup in gold. So I'll leave it at that because we've got a ton to get through.
Now, Andrew, I know this is well over 200 episodes, and I don't believe that we've ever talked about silver this early in our episode, but you got me really excited. You got me fired up about something major that's going on that we were talking about just before we started recording here in the silver markets. Can you share with the community what's going on here?
Yeah, absolutely, Shane. Obviously, look, it's unlike gold. This has been the problem with silver. Unlike gold, it's not yet been formally reclassified as a first-tier asset class. So, but nevertheless, it's a component of Beijing's war efforts alongside hedging, foreshadowed tariffs to come. Liquidity providers assess the relaxing of the SGE rules that we looked at last time is specifically focused on attracting large silver bullion flows into China to meet military and industrial demand. Now, as we outlined in our last episode, by incentivizing millions of smaller investors, that's the millions of SMEs that we looked at on the charts as well, incentivizing them to buy and to trade fully paid for silver, it is greatly impacting global supply, draining underpriced silver already facing a 4-year massive supply deficit. Now, while there is a commodity element to silver, silver is classified as money, which is why, unlike any other commodity, it trades as a foreign exchange cross. So, as I say, long silver, short dollar, yen, etc., or the other way around. Now, with pricing being established in the physical exchanges, where there is always a tradable buy and sell order for every single bar that is actually traded, it's also going to put silver onto the revaluation stair steps. And it's just as when the Bank of International Settlements reclassified gold as a first-tier asset class on the 1st of January 2023. And what they did was force the multi-trillion-dollar FX gold to become NSFR compliant, which meant that liquidity providers all of a sudden had to back each buy and sell order with physical gold. So that was a big change that changed what was really an unallocated market into a physical market. Now, by actually pricing physical silver or physically pricing silver in the FX markets, the silver fix event will produce the same result, which each silver bar will have a real buy and a real sell silver price, and a real silver price will emerge from that fact. It doesn't matter what the price of silver is, there's always going to be a buyer and a seller, but it's not going to be settled in the paper markets. And when we look back at silver in the rear view mirror, when it's trading with a 3-figure handle, yeah, you like that, Shane, it will be realized all the signs to act are really right under our noses now. And at the margin, this fresh SGE demand will be the next catalyst to drive a series of higher physically driven stair steps, this time also revaluing silver. It will begin to bullishly undermine the current bearishly skewed multi-billion-dollar options and OCC structures. We talked about these structures before. These are derivative structures. They're backed by nothing. Now, we've not really evidenced a real balanced supply-demand silver price, really, since it was fractionalized and diluted to be traded on the COMEX about 50 years ago. Now, with silver, with silver supply actually being sucked out of above ground stocks right now into this growing supply deficit, it actually raises the question which we raised last time. What is that price? And while no one exactly knows, every well-connected liquidity provider assesses it has to be a 3-figure price. And once the short squeeze and margin calls hit, it will happen faster than most people realize. This is why every single bullion bank, without exception, is long both gold and silver for their own books. So really, kind of to sum that up, at the margin, this completely unfactored, fresh, BRICS-driven SGE silver demand is going to make it impossible for the fast dwindling above ground supply. There's not enough supply for the so-called LBMA silver professional trade that they call themselves to suppress a globally driven spot silver price breakout into all-time highs. Now, liquidity providers give it till the first week in January for the lid to blow off. I mean, we are talking imminent here. And yes, the clues are all there under the deliberately induced chart noise. In other words, what's going on in the paper to physical battle, which is actually designed, it's the whole reason the COMEX was designed, to keep investors on the sidelines. into what looks like a non-performing asset class. Why? Because so much paper, silver, and gold as well has been introduced to actually make it look like that it's non-performing. Whereas silver has quietly been leading gold higher and is looking explosive. All our liquidity providers agree something large is going on in silver.
Now, Andrew, it'd be great if you could share some of the wholesale market footprints that you've captured, because it looks like, and I'm not the only one saying this, a lot of our community members are saying something is really wrong with the silver market. Maybe you can elaborate.
Yes, Shane. Here is one of several I have captured that really point to exactly that. Spot silver premiums above deliberately delayed. Now remember, the in delivery but locked in December delivery obligations, which came due on the last trading day of November. We talked about them as we executed our last contract. It was options expiry day. And we said, now the December contracts have to go into delivery on the last day of November. Now, what's been evident in every single Asian session since our last episode, which, as I say, coincided with the options expiration day, we're seeing massive demand. And we've been, and of course, when the US session comes on board, we see the paper markets coming in, but it's not working. Obviously, what we have evidenced is someone of very large size had got wrong-footed after being called for physical delivery at the back COMEX door. Captured in this slide on Tuesday morning last week, where we evidenced these in-delivery December futures lots traded at a massive, close to 38-cent backwardation to spot. Actually, it was as high as 40, but using 38 as the round number, it illustrated someone was having to pay these spot foreign exchange premiums over their underpriced, unbacked futures contracts, capturing the stress to deliver these locked-in contracts at current spot prices. In fact, there was exactly 999 5,000-ounce December lots that got caught in this 38-cent short squeeze, captured right there. That is 4,995 million ounces. And as of last night, there are still over 4 million ounces undelivered, indicating that these are also currently $2 underwater. Do the math. This is massive. This is an institutional nightmare. Now, this foot dragging to meet delivery contracts, we've talked about foot dragging in the past, where when something goes into delivery, why would you not dispose of those delivery friction, saving the carry costs and everything? If you've said you're going to deliver. Don't leave it till the last day of a month when you really should be delivering on the first day of a month. So, in other words, why do they do that? It's because they're trying. Age-old flows say if you do this and game it, you can probably get out of those trades and rig the price lower. So what I'm saying is this foot dragging to meet these delivery contracts evidences an institutional size misstep. And we have received credible information. This really very likely relates to the commencement of a very large Bank of America silver short squeeze. Now, we haven't got confirmation of this yet, but it really adds up. Our information is that the Bank of America had been caught short silver, borrowed from JP Morgan at around about $18, and that the bulk of it was sold short in late August 2022. Now, as we assessed following meetings with liquidity providers last week, fresh BRICS-driven SGE silver demand is going to make it impossible for the LBMA silver professional trade to suppress a globally driven spot FX price breakout into all-time highs. And while it's clear officials are on the wrong side of these OCC derivative, of this big OCC derivative hook, and they're behind the capping, they're likely using the Bank of America as a proxy. Really doubt that they're actually on the hook themselves. Nevertheless, someone has to pay the bill here. Now, liquidity providers give it until the first week of January for this lid to fully blow off. Now, with the SGE SME launch catching almost everyone wrong-footed, we hear JP Morgan wants this bullion back ahead of the SGE-driven, physically determined silver price revaluation fully kicking in. Now, more on this as it develops, as without a Bear Stearns-like bailout, this could evolve into a COMEX force majeure. We kind of drew attention to it last time without naming anything, but either way, with silver being settled outside of the CME LBMA ring fence, higher prices are coming. Oh, and before I forget, this short squeeze was still evident yesterday. We're recording this on Wednesday, so I recorded this on Tuesday, Tuesday morning in Asia, and spot silver was just challenging 32 spot, and it triggered off some more margin calls in the still undelivered December contracts, and they were forced into physical delivery. So there is your second evidence of this thing still dragging out.
All right. Well, Andrew, would it be a good point, I think, right now to take a look at this 13th of January 1 ounce CME gold launch?
Yeah, especially as this is an attempt by the CME's official ringmasters to divert physical demand back into the paper markets. But let's look how this effort to attract any meaningful liquidity is absolutely going to fail. Now, following the bullion banks beginning to step away from actually making markets between the Basel III, the non-Basel III compliant COMEX gold and the NSFR compliant BIS revalued FX gold markets, which were revalued as a first-year asset class, spec liquidity began leaching out into much more stable physical gold and or blockchain alternatives. So this latest open interest outflow of gold and silver into Bitcoin, we're talking unbacked casino betting chips going from one synthetic market to another, is proof, and both of them are unbacked and leveraged, it's proof the COMEX precious metals markets are experiencing an unsustainable speculator drain. So in an attempt to compete with rapidly expanding blockchain physically backed gold investments, the CME is attempting to attract speculators to trade massively leveraged 1 ounce gold futures on credit. Bottom line, directly after the BIS squared all of its over 700 tons of high counterparty risk gold derivative bets ahead of reclassifying gold as a first-year asset class on the 1st of January 2023, the legacy bullion banks simultaneously withdrew their market-making services, which, under license from the Fed, had managed the Fed's over 50-year mandate to cap the price of gold versus the dollar. They were happy to take the load and get bailed out. They're no longer willing to do that. Compliance tells them no. This marked the moment that the global-facing BIS and all of the central banks they represent, they all went long physical gold, leaving the Fed as the sole remaining central bank attempting to manage the foreign exchange dollar gold price. Now, this was also the pivotal inflection point where all the legacy market making bullion banks, who had also gone long for their own books, I might add, began to withdraw from making risky markets between, and obviously you've got one side that's 96% leveraged and unbacked and could default, and the NSFR compliant, Basel III compliant, deliverable FX gold markets. And really, you know, what compliance department wouldn't actually see that as a major risk? And since then, with prices increasingly being determined and settled in the unleveraged global-facing physical exchanges, CME speculator open interest has been, as I say, steadily evaporating out of the deliberately insider-rigged gold and silver casino, leaving the Fed to try and run the COMEX derivative show on its completely on its own. Now, they single-handedly took over the risky market-making COMEX to FX function by really tasking the bullion banks, privileged to have gold accounts with the Bank of England, to act on their behalf. Now, while these are the same first-year banks who have withdrawn making COMEX to FX markets for their own books, it places these 100% long bullion banks at a very distinct advantage. They know where the prices are, where the exact inflection points are, and where to really dig down and capitalize. And any fiat losses that ever arise from these Fed-run, officially sanctioned market-making activities are underwritten by the Fed. And however, as we've been tracking, the ability for foreign central banks to capitalize on this 96% leverage, exchange for physical discounted price, by locking in these contracts at a T+1 NSFR compliant delivery, forcing a T+1 compliant delivery obligation, it's revealed the Fed's weak fiat hand. The Fed-driven scam is coming to an end. And while the tail wagging the dog synthetically derived COMEX futures price serves to manage long-standing bets siloed inside this bearishly constructed 96% leverage multi-billion-dollar derivative markets, as we regularly see into options expiry events, major news events like non-farm payrolls, these debt-backed fiat gold prices heavily influence and effectively dilute the real NSFR-compliant deliverable global FX over-the-counter gold price. That's all well and good with this siloed price suppression scam. Before, it was all fine before the physical markets began to be settled in the unleveraged global and global south physical exchanges. Now, these game casino efforts to protect deliverable bets are grossly backfiring. And as we've been tracking, these central bank T+1 delivery demands are accruing at higher prices into less and less real specular open interest for them to short cover into, leaving the Fed just the two choices we outlined last time: is either shuffle this 96% mark-to-market shortfall into the Fed's ever-increasing fiat debt pile, or to go to market to buy the bullion at market. Well, actually, they're doing both. And we've just evidenced that as they repay the Bank of International Settlements borrowings at higher and higher prices. Now, unlike the SGE, where to open a long or a short trade, you have to buy a specific bar and own it. Before trading it, the Fed doesn't own any of the gold it trades. So what cannot be offset against this dwindling speculator open interest forces them to buy back these leverage bets at market to meet these actual NSFR compliant T+1 compliant delivery obligations. And what that's doing is draining liquidity out of the COMEX through this EFP mechanism into the compliant markets, tightening up global supply while driving prices ever higher. This is not rocket science. This is when reality really bites, and is precisely what is forging this series of higher physically driven stair steps, each of which has forced the Fed to short cover at higher prices. So in a desperate attempt to suck in fresh batch of useful fools, enter the CME with this cash-settled leverage fiat gold offering. Will they never learn? The CME is losing pricing power and is attempting to attract retail demand from Asia. But our experience tells us these savvy buyers have a generational respect for gold as money. And notwithstanding that putting weaponized dollars at risk, Asian buyers will not trust the self-regulated CME's completely unbacked fiat gold sham. It's going to fail miserably. And also, who the heck wants to make markets in a product that is undeliverable? And it doesn't even have the mechanism that the bigger contracts has to convert these bets into NSFR compliant, Basel III compliant gold. So who the hell is going to make those markets? Nobody.
Well, Andrew, I need you to address something. I know we've had many questions from the community, and I personally received a lot of questions, and I promised that I would ask you this question. And it's regarding, of course, Trump's threat to impose 100% tariffs on any BRICS nation that dares to challenge the mighty US dollar. Tell us what's this about, because I really don't know.
Yeah, so I know I've had so much feedback, a ton of questions that had to be addressed, and this is perfect, Shane. Let's delve into Trump's BRICS tariff threat. Now, while this likely is just posturing to try and come in and bat a strong hand, don't blame him. Let me feed back what really our well-connected global-facing liquidity providers really anticipate. Now, cutting to the quick, further weaponizing the dollar is extremely bullish for gold. Now, here's why. Bottom line, Russia is an energy and agricultural superpower. So existing sanctions already necessitate ongoing settlements that utilize national currencies. So until Trump removes the main sanctions on Russia, it's possible these non-dollar BRICS pay settlements will continue to expand. BRICS is a rising force that has already overtaken the G7, and given the expanded BRICS trading nations either produce or consume 85% of all global commodities, including energy, tariffs will likely backfire on the US more than it impacts the BRICS nations simply dealing amongst themselves. Now, while Trump's BRICS sanction threats may actually temporarily put a hold on formalizing the named launch of a SWIFT-like alternative settlement currency, as far as gold is concerned, it will not halt the ongoing globally driven FX gold price revaluation process. In fact, liquidity providers assess that these threats of further employing the dollar as a geopolitical weapon has already begun to accelerate the usage of the BRICS pay decentralized payment system, enabling BRICS members countries to trade with each other using their own currencies. And as we've previously assessed, I mean, the wide range of national currencies are not equal in value. So when pricing an equitable price to settle a specific trade between nations, it is the percentage of gold that backs that nation's currency which provides the tradable benchmark to price that commodity transaction. In other words, how many grams of gold that nation's FX currency buys so as to value the trade. And that live FX benchmark price then values the commodity trade or currency swap, which can then be hedged. Hence why every BRICS global South facing and Western central bank, alongside billions of dollars of safe haven institutional demand, are all busy converting dollars and US treasuries to gold. This process will not stop. Now, current reports of fresh Chinese central bank buying absolutely, while they're on the news and it's bullish, people are saying, well, look, China's back buying. It pales in comparison to the non-stop continued monetary gold purchases. So in the meantime, every single global central bank except the Fed is accumulating gold. If anything, and I'm not joking, the smart move would be to lean into Basel III compliance and start backing the dollar with gold. It's not such a crazy idea if you're caught naked short using unfunded government liabilities into a global short squeeze. Now, if anyone could force a US Treasury gold price reevaluation, it would be Trump. And then what then after that, what use would the Fed be is the next question. Let's see what Judy Shelton gets up to in January, shall we? Now, the only question remaining, though, is what percentage of your rapidly debasing, depreciating dollars, pounds, euros, yens have you protected with zero counterparty risk, physical gold and silver, guys?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same, and don't be fooled out there. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. And please help keep spreading the word about this channel by hitting that like button right there. Just go ahead and hit it. Share this information so more people can find out about this channel. Subscribe if you haven't already done so, and click on that bell right there, and we'll notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.